Welcome back to the Pro Ticker Podcast, your Wednesday morning edition covering major financial magazine headlines, everyone.
Thanks for having me back. Uh, Looking at the sheer volume of news on the desk today, I really don't think we could have picked a more consequential Wednesday to break down.
Seriously, I mean, today is Wednesday, February 25, 2026. And if you are listening to this and feeling a bit of vertigo this morning, you definitely aren't alone. We are dealing with a massive news hangover right now following President Trump's State of the Union address last night.
Which, just for the record, was the longest in history.
Yeah, it was.
But the length really isn't the story here.
Yeah.
It's the structural shifts he proposed.
Yeah.
And the immediate, almost chaotic market reaction we are seeing this morning.
For sure. And we're pulling from a bunch of sources for this deep dive today. Yahoo Finance, CNBC, Bloomberg, and Reuters. Just trying to make sense of this because what's really striking is how we seem to be living in this split-screen reality. On one side, you have this huge constitutional clash, the president basically taking on the Supreme Court regarding his trade authority. And then on the other side, the stock market is just having a total schizophrenic episode.
Yeah, it's deciding which AI companies are basically gods and which ones are entirely obsolete. It really is a tale of two realities. You have the macro-political layer, where the literal rules of global trade are being rewritten in real time.
Right.
And then you have that micro-market layer, where investors are just ruthlessly filtering winners and losers based on this agentic AI thesis.
Well, let's start with the macro, the State of the Union.
Yeah.
Because the atmosphere in that room was, let's call it charged.
That's a diplomatic way to put it.
Yahoo Finance noted that, usually there is a level of decorum with these things, but Trump went directly after the Supreme Court regarding their recent ruling on tariffs. Right to their faces.
He did not mince words at all. He called it an unfortunate ruling and lamented their unfortunate involvement. And you have to remember the visual here.
Right, they were right there.
Exactly. The four justices in attendance were sitting just a few feet away, completely motionless. It was visceral representation of the friction between the executive and judicial branches right now.
But here is where I really want to push on the actual policy, because at the end of the day, that is what moves the money for you listening. The Supreme Court recently struck down his use of the IEPA.
The International Emergency Economic Powers Act.
Right, the IEPA. The court basically said, look, you cannot use emergency powers for your standard everyday trade policy.
Correct. They ruled that the act is for genuine unforeseen national emergencies, not for, implementing a permanent economic agenda.
So logically, if you're following this, you'd assume the tariffs would just stop. But then Trump stands up at the podium last night and says, quote, the deals are all done. He says no changes are coming. My question is, legally, how does he justify that? Is he just flat out ignoring the Supreme Court?
He isn't ignoring them. He's flanking them. And this is the pivot that Bloomberg highlighted this morning. And it is easily the most technical but important part of the entire speech.
Okay, break that down.
Since the IEPA is off the table now, the White House has basically dusted off Section 122 of the Trade Act of 1974.
Section 122, I feel like we haven't heard anyone cite that statute in decades.
We really haven't. And that's because it's designed for a very, very specific scenario, a balance of payments crisis.
Okay.
Essentially, if the U.S. is bleeding too much capital globally and has a massive trade deficit, the president has the unilateral authority to impose a surcharge of up to 15% on imports to stabilize the nation's balance sheet.
Wow. Okay, so he is reframing the overall trade deficit as a balance of payments crisis to bypass Congress entirely.
Precisely. It's a massive loophole. It gives him temporary authority. Usually it's limited to 150 days, unless Congress extends it. But it allows him to act immediately. And that is why, as of yesterday, a 10% global import levy effectively kicked in.
Wait, I saw some confusion about that rate, actually. He threatened 15% over the weekend, right?
He did, yeah. And he still holds that 15% threat over the market's head as leverage. But the actual memo from Customs and Border Protection that went into effect Tuesday set the levy at 10%.
Oh, got it.
So despite that big Supreme Court victory for free trade advocates, the tariffs are very much live. They're just living under a different legal justification now.
And he isn't stopping at 10% either. CNBC reported on a luncheon he held before the speech where he proposed something that sounds almost like a return to the 19th century. He wants to replace the income tax system with tariffs.
Yeah, this is the wild concept everyone in Washington is buzzing about today. But we really need to look at the math here.
Right.
He explicitly said he wants these duties to, quote, substantially replace the modern-day system of income tax. And look, politically, that plays incredibly well. But, no tax on your paycheck, we just tax foreign goods.
Sounds great on a bumper sticker.
Exactly. But economically, it implies a massive, almost unfathomable structural shift.
Right, because to replace the literal trillions of dollars we get from the income tax, you would need tariffs that are just astronomically high, wouldn't you?
You would. And you fundamentally shift the tax burden from what you earn to what you consume.
Which is regressive.
Highly regressive. Lower-income people spend a much higher percentage of their money on physical goods. Plus, it completely changes the cost basis for every single company in the S&P 500.
Yeah, if you are Ford or Apple, your supply chain just got 10 to 20% more expensive overnight.
And then you have to decide whether to eat that cost and hurt your margins or pass it to the consumer and fuel inflation.
Speaking of supply chains and unintended consequences, actually, I want to pivot to a fascinating detail from that CNBC report regarding India and Russian oil, because this seems to be a case where the Supreme Court ruling actually backfired on the administration's goals.
Oh, the law of unintended consequences is practically a physical law in economics at this point.
Walk us through this, because the report says the court's decision to strike down the IEPA usage actually helped India buy more Russian oil. How does the U.S. losing the legal authority to punish someone result in them getting a better deal?
It all comes down to the hierarchy of the tariffs. So, previously, under the IEPA, Trump had targeted India specifically. He slapped this punitive 25% tariff on them for buying what he called war machine oil from Russia.
Okay, so a heavy penalty specifically for India.
Right. But after some negotiation, that was lowered to a specific 18% rate as sort of an interim deal.
Okay, so India was paying 18% because they were basically in the penalty box.
Exactly. But then the Supreme Court comes along and says, no, you can't use the IEPA for these trade maneuvers. That ruling invalidated the specific authority used for that 18% penalty on India.
I see where this is going. If the specific penalty is illegal,
then India just defaults back to the general bucket. And as we just discussed, the general bucket under Section 122 is currently set at 10%.
that is incredible irony. By winning the argument that the president overstepped his authority, the legal system inadvertently gave India an 8% tax cut.
Completely. And so the U.S. just lost massive leverage. Kraepler analysts are projecting India will import about 1.16 million barrels per day of Russian oil in February.
Wow.
Yeah. Before the ruling, that number was expected to drop significantly because of that 18% tariff. Now, they have the financial room to keep that volume high. Analysts think it'll settle between 800,000 and 1 million barrels simply because the financial penalty just got diluted by the courts.
It effectively lets New Delhi maintain their multi-alignment strategy. They can buy from everyone, and the U.S. doesn't have a specific stick to hit them with anymore.
Correct. The Supreme Court effectively broke the stick.
While we are looking globally, we have to touch on China, because Trump is visiting Beijing soon. He'll be the first sitting U.S. president since 2017 to do so. Yet the SOTU barely mentioned China. He focused on domestic inflation and Venezuela instead. That felt deliberate.
Oh, it was likely a very tactical silence. You don't tip your hand right before a high-stakes negotiation. But we have to acknowledge that the economic backdrop has changed drastically since 2017.
The data from CNBC's China Connection newsletter really highlights that decoupling. U.S. reliance on Chinese exports has dropped from 18% in 2017 to just 9.6% now. That is a massive shift in less than a decade.
It is huge, and that changes the leverage going into Beijing. China's Commerce Ministry is publicly urging the removal of tariffs, but they don't have the same economic hook into the American consumer that they once did.
Right.
So if Trump comes back from Beijing with a deal, he frames it as a victory. But if he comes back with nothing, he could just frame the hardline stance as a victory for American independence.
Heads I win, tails you lose.
It's standard operating procedure for this administration.
Yeah.
But look, while the political world is entirely fixated on these tariffs, the financial markets are telling a completely different story. And this is where we need to look at what I'm calling the tale of two tech stocks.
Yes, this split is the defining story of the morning. We have NVIDIA on one side and Workday on the other. It feels like the market is finally distinguishing between AI infrastructure companies and AI victims.
Exactly. It's the classic pick and shovel play versus the displaced worker fear, but playing out in real time.
Let's start with the winner here. NVIDIA. They report Q4 earnings today after the bell. Yahoo Finance is calling it the most anticipated announcement of the earnings season, and expectations are just sky high.
Sky high might actually be an understatement. Analysts are looking for earnings per share of $1.53 on revenue of $65.8 billion. Just pause on that for a second. $65.8 billion in a single quarter.
It's staggering, and the driving force isn't just general retail interest anymore, it's the capex from the big guys. I saw a figure in Bloomberg that the hyperscalers, so Amazon, Google, Meta, Microsoft, they are planning a collective $650 billion in AI capital expenditure for 2026.
That $650 billion is the key number for anyone investing right now. That is money already committed to building data centers. That capital has to go somewhere, and right now the vast majority of it is flowing directly into NVIDIA's pockets for their new Blackwell Ultra chips.
Why specifically the Blackwell Ultra? I mean, is it just about raw speed?
It's efficiency and density. These hyperscalers are literally running out of physical space and power grid capacity. The Blackwell Ultra offers significantly more compute per watt. So if you are Microsoft and you have a strictly fixed power budget for a specific data center, NVIDIA is really the only game in town that lets you maximize that electricity.
Which explains why the stock is up, what, 5.6% in the last 3 months, despite already having a massive valuation.
Exactly. And with their GTC 2026 event coming up in San Jose, the product type is just compounding.
But then you look at the other side of this AI trade. Workday, ticker WDAY. This is a very solid company. They're a staple in HR and finance software, and they actually beat their earnings estimates.
They did. Adjusted EPS was $2.47 versus the $2.32 expected. By any traditional metric, the stock should be up today.
Right. But instead, it plunged 9 to 10% in the pre-market and is down nearly 40% for the year. This isn't about the past quarter at all, is it? It's about the future guidance and this buzzword we keep hearing, agentic AI.
Yes. Agentic AI is the existential threat to the software as a service business model. Think about how a company like Workday makes its money. They sell seats. You pay a monthly or annual license fee for every human in your HR or finance department who needs to log into the software.
Right. It's basically a headcount tax for the enterprise.
Exactly. Now enter agentic AI. These aren't just simple chatbots that answer FAQs. These are AI agents that can perform end-to-end tasks independently. If an AI agent can automate 40% of the manual work in payroll processing or recruiting, a company simply doesn't need as many human HR officers.
And if you don't need the humans, you don't buy the software seats for them.
Precisely. The market is looking at Workday's guidance, which was notably weak on subscription revenue, and they are interpreting it as the very first sign of this structural decay. If companies start hiring digital workers instead of humans, the entire revenue model for seat-based software collapses.
Now, Workday's CEO, Anil Bousri, tried to fight this narrative on the call. He said AI won't displace traditional software, but investors clearly aren't buying it. They are actively dumping these application layer stocks.
Because the risk is inherently deflationary. If AI makes businesses hyper-efficient, they spend less on software licenses, not more. Investors are terrifyingly efficient at pricing in that future. They are selling the companies that might get automated and buying the company NVIDIA that is selling the automation hardware.
Which is brutal, but makes total sense. And this bifurcation in the market really brings us to the overall mood on Wall Street, because we have two very different takes today from two heavy hitters, Jamie Dimon and Jim Cramer.
Oh yeah, it's the ultimate pessimist versus the pragmatist matchup.
Let's start with Jamie Dimon at JP Morgan. He is heavily sounding the alarm. He is comparing the current market vibe to the 2005 to 2007 era. His exact quote was, "I see a couple people doing some dumb things."
Yeah, Dimon is looking closely at leverage, specifically in the private credit markets.
Yeah.
His concern is that these sky-high asset prices, driven mostly by this AI boom, are masking a lot of bad loans and excessively risky behavior underneath.
Just glossing over the rot.
Right. When he says a rising tide lifts all boats, he's implying that when the tide inevitably goes out, we are going to see a lot of wreckage on the shore. He's warning the street that trees don't grow to the sky.
But then you have Jim Cramer on CNBC offering more of a survival guide for this specific environment. He came up with an acronym that I actually think is quite useful for retail investors right now, HALO.
HALO. Heavy assets, low obsolescence.
Break that down for us. It sounds like a purely defensive play.
It is a defensive play, but a smart one. Cramer is advising investors to pivot their portfolios toward companies that own tangible, physical things, heavy assets. So we're talking pharmaceuticals, consumer staples, industrials, things that you can physically touch.
The logic being that, sure, AI can write incredible code, but it can't manufacture a tube of toothpaste.
Exactly. His golden rule right now is buy things you understand. Yeah. But the real insight was his warning to avoid stuff you can't explain to a friend. Because, as he put it, that is the stuff Anthropic can wreck with a simple press release.
Wow, wreck with a press release is a haunting line. But it goes right back to Workday, doesn't it? If Anthropic releases a new model that does perfect enterprise accounting, Workday has an immediate crisis. But Johnson & Johnson is totally safe because ChatGPT cannot replace a Band-Aid.
That is the absolute crux of it. We are seeing a massive flight to physical safety amidst all this digital chaos. People want tangible value when the software world feels so vulnerable.
Okay, before we wrap up this deep dive, I want to connect one final dot for you listening. Because we talked about NVIDIA, we talked about the $650 billion in capex and the intense energy demands of these chips. There was a specific detail tucked away in the State of the Union regarding energy that fits perfectly into this puzzle.
You're talking about the Ratepayer Protection Pledge.
Right. Trump mentioned that the U.S. power grid is simply too old and the electricity demand from AI is too high. He claimed last night that he secured a pledge where big tech, the exact same hyperscalers spending that $650 billion, have to fund their own electricity usage.
This is a massive development if it actually holds up. Essentially, the administration is telling Amazon, Google, and Microsoft, look, you cannot crash the local grid for grandma's house just to run your advanced chatbots. You have to build your own power plants.
Think about the capital implications of that. It's not just buying servers and chips from NVIDIA anymore. If you want to play in the AI race in 2026, you now have to be a utility company. You have to physically build the generation capacity, whether that's small modular, nuclear gas, or solar, just to run those Blackwell Ultra chips.
It raises the barrier to entry significantly. Nobody new can jump into the space. And it connects right back to that CapEx number we discussed. A huge chunk of that $650 billion isn't just going to silicon anymore. It's going to concrete, copper wire, and turbines. It effectively privatizes a massive expansion of the U.S. energy grid, entirely funded by tech balance sheets.
Which actually makes Cramer's Halo argument even more interesting. The biggest tech companies in the world are being forced to become heavy asset companies out of pure necessity.
Yeah, they're basically becoming nation-states with their own dedicated physical infrastructure. It's wild.
Well, from tariff loopholes reshaping Indian oil trades to AI companies building their own power plants, there is certainly no shortage of complexity this week. We will be watching that NVIDIA earnings call closely tonight to see if the AI trade really has more room to run.
And I'll be keeping a very close eye on Section 122 to see how global markets actually respond to those tariffs being live.
Absolutely. We'll see you all tomorrow morning with new headlines from major financial magazines.